Hello, Ziegfried here from Cloud-Based Services Accountants. Today I would like to talk to you about tax returns. This time of the year we're doing a lot of tax returns and usually get quite a lot of questions about the tax returns, and I thought it might be a good idea to explain to you, just to give you an explanation of the layout of a tax return. Before we carry on, I just would like to just mention that everything I say is from a New Zealand tax perspective. I'm a registered New Zealand tax agent and accountant. So without further ado, let's quickly share the screen with you, and let's dive into this and have a look at a typical tax return. So in this instance, you will see that there's a tax return that's been created for the 2021 tax year, and the layout is basically usually the same. Hopefully that income amount will be a lot more, but this is just for explanation purposes. So let's go for it. On your tax return, right at the top, you'll see your income. So this can be income with tax deducted. So if you're working for an employer, then the employer will deduct pay as you earn from your salary or your wage, and that PAYE deduction will be indicated on your tax return as a credit. So you'll receive credit for that amount that's been deducted. Great. So the next thing that we'll see on a tax return in some instances is income from dividends. So now that's not something previously that the average taxpayers saw on their tax returns, but lately IRD included what they call PI income from shareholding, or from, let's say, your KiwiSaver funds, your shareholding in that KiwiSaver fund. It's declared as dividends or dividend income, and unfortunately, but yes, you're also taxed on that. So and luckily for you, that tax is already deducted by the KiwiSaver provider or the company where you hold your shares. And in this instance, you can see that the dividend income is $110, and there is dividend withholding tax deducted. So that RWT stands for resident withholding tax, and you can see you get credit for that tax that was deducted. Great. And then the last part of this is, and that's not always the case, but you might, from time to time, you might see imputation credits. Now what that means is usually, and it depends on the type of shareholding, and that usually is when you have shareholding in a company, and the company distribute dividends to the shareholders, then the company must pay the tax on those dividends that's distributed. And for you as the shareholder, you will receive imputation credit. So that tax that the company paid over on the distribution of the dividend, you will receive the credit for it. So the full dividend is declared in your name and that income, but you will receive that credit. Now we have company shareholders, and they don't really understand how this works in New Zealand. So you will see a company's tax rate is 28%. So that's great. But when the company pays the shareholder a dividend, then there is a 5% dividend tax, or tax payable by the company on that dividend declared to the shareholder or distributed to the shareholder. So in effect, the tax, when the shareholder receives that dividend in his hands or her hands, there will actually be 33% tax paid on that. So initially the 28% the company paid, and then for the company to distribute it further to the shareholder, another 5%. And that credit that you will receive, that 5%, you will receive it here as imputation credit on your credits on your tax return. So in this instance, that's 336. So yes, so this is basically all the tax returns. Doesn't matter how much money you earn, this is basically the way it looks. And so just to summarize, so you've got your income, your total income there. That's now including your salary and perhaps your dividends and whatever other. You can also have, let's say, shareholder income, shareholder salaries and things like that from the business and so on. That's your total income, and that's basically the calculation of the tax payable on that income. So you can see your tax payable on that income is 8476. But you have received credit. So you have received credit for the imputation credit, so that's the dividends, as well as the withholding tax on, let's say, your KiwiSaver deductions, and then obviously also your PAYE deductions. Now, something interesting that you will see here is that if you look at that, is the actual credit that you receive, and that's the total of that one, and obviously that one and that one is 876325. So this means that you have overpaid tax. You can see that this amount here is more than that one, that's your actual tax payable. So you get credit for that, so or a refund, and that's when you will receive a refund. So let's say in this scenario it was the other way around, where your tax payable was, let's say, more on that side and less on the side that on the credits you receive, then that will be tax payable. So hopefully this clarifies your tax return. And yeah, if you've got any questions in this respect, you're welcome to get in touch with me. Our contact details are right below, and looking forward to chat with you again. See you next time. Cheers.